Rob Scott, very good to sit down with you over in the West.
Great to be here.
Now, lots to talk about in this result, but overshadowed today by this underpayment scandal. Now at Target, Coles, during the time when you owned all of Coles, on top of the super issue at Bunnings and in the industrial segment.
Well, look, very disappointing. And as soon as we became aware of these issues last year, we commissioned a very detailed review across all of our divisions. It's been good to get towards the end of that review. We have identified some further errors, which very disappointed about, but we've now identified what needs to be done, and we're getting on with repaying people with interest and also putting in place processes to reduce the risk of this in the future.
So I'm just trying to get my head around the numbers. You said today that it's impacted less than 1% of the workforce. That's about 2,000 employees. But back in October, underpayments in the industrial segment alone was 2,000 and 4,000 former employees. So it must be more than 1%.
Sure, no, absolutely. So the overall cost of this represents much less than 1% of our overall payroll. Remembering that this goes back...
Payroll, so not the employees.
No, that's right. And this goes back over 10 years. So this has been a very detailed review going back a long time. So the amount is relatively small in terms of our overall payroll, but I want to emphasise that does not minimise this issue. It is unacceptable.
So, yeah, I mean, you don't think any sort of penalties for those involved would do much good. I suppose my question to you is, you know, you're one of the largest employers in the country. You often proudly say that at Wesfarmers. You, Woolworths, we've had the same thing, another big employer. How is this going to go down with the Prime Minister, who's sensitive to issues like this, when you go to his door and say, we'd like reform for big business, we'd like more opening hours, all this sort of stuff, when you've sort of fallen at the first fence for him?
No, well, look, there are already pretty significant penalties involved in terms of the penalty interest that justifiably you need to pay to the team members that you've underpaid. And the cost for us to remedy this have also been quite significant. So there are penalties in place, and there should be penalties in place. I guess what I'm saying is that I think what we've seen within large corporates in the last 6 to 12 months is people moving very quickly to address these issues. It has been a wake-up call for a lot of companies. I'm yet to meet a CEO that isn't facing into this very quickly.
But you'd be pretty angry if you were the Prime Minister trying to do something about wages growth and then hearing about this at the big end of town.
Look, I think it's really unfortunate that I know that certainly ourselves, we pride ourselves in a strong corporate reputation. The relationship we have with our teams is paramount. And I'm just really hopeful that the actions that we're taking to respond very quickly and diligently, that our team members will respect that, and we can both get on together and work collaboratively together.
All right. Your shareholders happy with the overall operational result? I think the share price is up. The big story, of course, was your sell down of your investment in Coles from 15 to just above 10%. Now, what's the thinking behind that?
Sure. Well, when we announced the demerger, we were conscious that this was the biggest ever demerger in Australian corporate history. We have a very large retail shareholder base, and we felt that to retain 15% was important to show that we had skin in the game in the
rather
future
than
success.
Go down to 10 straight away.
That's right. So 15% was a meaningful amount. We were also mindful of the ongoing collaboration that we have with Coles on Flybuys, and we're joint venture partners, and having this ongoing connection through the shareholding just adds to that strategic alignment. So
you and the board, I think, have been vindicated in that Coles share price since the demerger has gone up, what, a third or something. So that's nice to have back now. The Flybuys, though, going forward, that's a beautiful thing, isn't it?
I think it's a great business, and I think there's a lot more opportunity for both Coles and Wesfarmers to use Flybuys to add even more value to our customers.
Would you ever think of floating that off jointly?
Well, I think there's a lot that we can do to get on and create value for our customers and value for our own businesses before we think about that. So selling down the 4.9% was really just about taking some profit off the table there. If we thought that it was the top of the market, we clearly would have sold all of our shareholding. We think Coles is a good business with good prospects, and we're very pleased to have a seat at the board table through our 10.1% stake.
I get the impression that the board and yourself, this whole story with Coles and AI and Flybuys, we're only part way through this story.
Well, I think what we're seeing in many industries, and retail is a great example, that data and digital are just becoming such an important part of our offer to customers, how we engage with our customers, how we improve the productivity of our team in stores, the decisions that we make. And it's something that I'm very passionate about and why we've invested so much in this area within our Wesfarmers businesses.
What are you going to do with the money you've got from that 5% in Coles?
Well, at the moment we'll work through some of the tax implications of the sell down. We don't sit on a lot of franking credits, so our philosophy is that we pay out most of our franking credits because they don't have any value to us, they only have value to our shareholders. So we will review our balance sheet position in the coming months. If we feel we have surplus capital, we would look to the most tax effective way of getting that capital back to shareholders.
So you've been in the chair now for over 2 years. You obviously early on got rid of those British assets. Where is the growth story, I suppose, in it? What's the philosophy that you have for this conglomerate, Rob?
Yeah, well, I'm very deeply ingrained in the Wesfarmers corporate objective, which is to deliver satisfactory returns to our shareholders over the long term. We do set the bar high and we do aspire to deliver better than market returns over the long term. But what really matters is how do we improve returns. It's not a matter of what do we buy or what do we sell per se. It is about how do we allocate our capital in a way that will deliver superior returns. So I'm finding at the moment that now that we've repositioned the portfolio, we have a group of businesses that have the capacity to deliver really good returns. And actually at the moment, a lot of our energy is focused on investing in those businesses, investing more in digital and data, investing in bolt-on acquisitions and bolt-on investments that I think can deliver some really good returns. Now, it might not be the big bang investment that some people would like to see, but at the end of the day, sometimes the big investments don't always deliver returns to shareholders.
Oh, indeed. But you would still see Wesfarmers as a growth stock, because at a time when people are asking those sorts of questions about, say, the big miners, whether they just become dividend stocks, you would see Wesfarmers as a growth stock.
Oh, absolutely. And I do think that the unique opportunity that we have within our portfolio of businesses is we have a very resilient, defensive portfolio of businesses, particularly when I think about Bunnings, Kmart, our chemicals, energy and fertiliser business. But we also have demonstrated in businesses like Bunnings, Kmart, Officeworks and chemicals that we can deliver growth. So certainly we are focused on growth, but you can deliver a lot of growth without necessarily going out and buying new things. So it's about, really our focus at the moment is getting more out of our existing businesses.
Just on carbon, you're not part of the Net Zero 2050 Club, are you? Why is that?
Well, we have really focused, we've been very focused on reducing carbon emissions for many, many years. And we wanted to really distinguish ourselves by a company that is taking meaningful action right here today. I could and our board could, we could quite easily come out and make a promise around 2050. But what really matters is what we're doing today. So we did last year set targets for 2025 that have 25% reductions within our Officeworks business, 20% in Kmart, 10% in Bunnings, and reducing emissions intensity in Wesf. I think.
But are you saying that you're going to beat that? Because that's what the BCA is sort of talking about, isn't it?
Yeah. Well, look, we're reflecting on where we go with this. At a personal level, I think there is no alternative but for our country and for the global economy to be focused on moving towards net zero. But we need to start having a mature discussion about what that really means. A world of net zero in 2050 doesn't mean that there will be no carbon emissions. It means that the emissions intensity must be much lower, and there will be some businesses and some opportunities to have negative emissions. So we need to have a mature discussion.
But we need an energy policy, wouldn't you agree?
That will certainly be important. I think the other thing that we need to realise, I think two other things to realise is, first of all, we will not achieve that target unless there is multilateral government support around and alignment around policy. So
which there isn't at the moment, is there?
There isn't, but that is going to be critical. The other thing we need to recognise is this is all part of a transition that we need to go through. And transitions don't happen in a linear way. They happen in a different way over time. And there will be some consequences and costs associated with those transitions. So I think recognising some of those disruptions and cost implications is really important.
Finally, need to ask you about Corona and your thoughts on China at the moment, because you have a sort of direct eyes on, don't you, through Kmart?
We do. So we have a lot of very direct relationships with a lot of factories in China and also in the Asian region, and we are monitoring that very closely. At this stage, it's too early to call whether there would be a material impact. But the risk, I guess, that we're focused on is, first of all, it's the movement of employees back from the Chinese holiday through the Chinese holiday period back to their places of work in the factory. We really need to see that flow of workers start accelerating, and then we need to see the factories get back online, and then we need to see the supply chain start to flow. So I think over the next 4 to 6 weeks we'll have a much better idea on whether this is going to start to impact the flow of product into our supply chain.
Rob Scott, thank you very much for joining me.
Thanks, Tiki.